Cool, so meeting over in a lovely black cab. I'm always surprised how spacious these are. So I've jotted a few points down because I don't want to miss any. And the thing is, everything I'm about to say of why I'm pro renting and not owning is, it may not be the case for everyone, but for me personally, this is the way forward. And the main reason being is that I am obsessed. I'm absolutely obsessed with opportunity cost. And the thing is, if you dump 30 grand into a deposit, your money is doing jack shit. It's not doing anything. You're just basically parking your money, sat there, thumb in bum, minded neutral, and doing nothing. Whereas with me, I mean, especially if you have a business, if you, like I could put 30 grand into one of my businesses, mainly on Facebook marketing, and then within a matter of months that 30 grand would turn into 60 grand. So I like moving money. I like making money work for me. And you need to imagine that each little £1 is like not a soldier, a miner. Okay, so you have 30,000 miners there, and by parking it into a deposit, you're basically not putting those miners to work, and they're going to end up either eroding away through, loss of purchasing power because of the currencies, or they'll just go to the pub, and then they won't do any work. So you need to put your little miners into a little mine and get them working. So that's one of the things I look at. So yeah, and also the value of currencies is declining massively. So the pound, the dollar has lost about 90% in value over the last 90 years, 2/3 of that in the last 40 years. And that rate of decline is not slowing down. And the main reason being is that from sort of 1975 onwards, when the Bretton Woods system was completely demolished, every nation on the planet has been printing currency away like no tomorrow. And the thing is, global currencies are in exponential growth. And so as more currencies are effectively printed, the value and the purchasing power of your pound, dollar, rupee, yen, euro, whatever it may be, is also losing value. So if you're basically valuing your house in a massively inflating currency devaluing currency, it's not worth half of what you think it is. Also, another thing is that property doesn't always go up. So yes, if you look at the big fundamentals, the UK is a tiny island, population is in exponential growth, and so land values should continue to go up. So personally, I like land, not buy-to-let, not like residential property. I like land. Obviously, if we have some sort of global catastrophe and like Ebola kills 90% of the world's population, not a laughing matter, then land values will massively drop. Hell, that's your worth. That's the least of your worries if that happens. But the thing is, from 1900 to 1965, UK property did zero, jack shit. It was flat. And the reason why property prices have gone up massively since then is currency growth. If your currency is being effectively printed in an exponential fashion, that has to go somewhere. What tends to happen is that the financial sectors and the property sectors just hoovers it all up. I also see a lot of people where they go, oh yeah, I bought my house for X amount 20 years ago, and it's now double the price. I put 100 grand in, and it's now worth 200 grand or even 500 grand, etc. Well, the thing is, it's all relative. You're not actually any wealthier if you want to remain in that place you live. So let's say you bought somewhere in London, it's gone up silly percent, and you're now technically a millionaire on paper. Well, if you were to sell up and then buy another house on that street, you're not any more well off. You still you won't end up with extra profit. So you will only realise that profit if you sell up, say in London, then go and live in Skeggy or anywhere. That's when you can realise the wealth, and it won't actually be you won't actually realise that much wealth. Again, you're going to be hammered in stamp duty and all the other costs that come with it. I've seen people where they've said they've doubled or tripled their wealth over 20 odd years. When you do the math, doubling your wealth over 10 years is a bit shit, to be honest. So yeah, and again, the value of what you think your house is a lot less than you think. For example, let's say you bought a house for 500 grand in, I don't know, 2000 sterling in, say, 2005, 2007, and now let's say it's worth £1 million. Well, yes, you may have made an extra 500 grand in pound sterling, but when you look at that against the dollar, it's actually $850,000. So you've actually lost $150,000. So it's all relative in what you look at, and if you start valuing your stuff against other things which aren't being inflated away, then you'll realize your house has actually crashed in value against pretty much everything. Barrels of oil, bushels of wheat, pretty much any commodity, gold and silver, your house has crashed in value. So you need to understand that there's a big difference between value and price. Oh God, the house price to earnings ratio has gone way out of whack. I'm a bit rusty with the actual ratios right now, but I mean, now I wouldn't be surprised in some parts of the UK where it'll be like 10 years earnings for your house, which is a bit nuts. And then in some parts of the world, it's like in the 20 years earnings for a house, which is just nuts. Also, rates. This is a biggie. So there's a thing called historic complacency when people are looking at houses, or investing in general, and they think people are very myopic. They think they have like a 5-year outlook, and they think, oh, what have interest rates been for the last 5 years? And they look at the rates and it's, I don't know, 0% or 0.25%, and they think, oh, that's the norm. And they then go and buy, they max everything out, and they go all in on a house which they can't really afford, basing it on a tracker rate of, say, 0% rates, because they think, oh, that's the norm. But what most people don't understand is that the 300-year average for UK base rates is 7%. 7%. And the thing is, markets are cyclical. So so if 7% is the mean, basically markets are always overshooting. They always gravitate to the mean, but they always overcompensate. And so at the moment we're at 0%, if not negative rates, and it will at some point try to head back to the mean, and it will probably overshoot. And people forget that in the 60s, 70s, 80s, and 90s we had double-digit rates. I remember my dad going nuts in the 90s when rates hit a sort of 15, 17%. Whew, it's hot in this cab. Hell, in 1992 rates went up 5% in one day when the UK dropped out of the ERM, European rate mechanism, exchange rate mechanism. So yeah, so that's that one. And put it this way, there are a lot of people on a tracker rate mortgage, so variable rate mortgage, so SVR, standard variable rate mortgage. So let's say you've got a £200,000 mortgage on an SVR. For every 1% that UK base rates go up, your mortgage goes up around £120 per month. So let's just put it this way, rates don't even have to go back to the 7% average for you to be absolutely screwed over. Let's just say rates go up 3% from where they are now, okay, which is really achievable and believable. So if base rates go up 3%, your mortgage goes up an extra £360 per month on top of what the mortgage is. And 90% of the population can't afford an extra 60 quid a month, let alone an extra 360 quid. So that's going to create a wave of foreclosures, people forsaking their mortgages, handing the keys back, etc., just because they can't afford it. When rates start going back up. So yeah, when you look at the bigger picture, we're 300-year lows for interest rates, 300-year highs for house prices. It's nuts. This is the worst time ever in UK history to buy a freaking house. that's why I'm not that keen. And a lot of people think, oh, I'm missing out, you know, on the growth if I don't get on that property ladder. Well, there are smarter ways to sort of get exposure to that equity growth. So what I recommend, and what a lot of billionaires recommend actually, is that you rent where you live and you own where you rent out. Okay, so this is a bit of an interesting one. So you rent where you live, literally the house where your home is, so to speak, and you own what you rent out. So that way, the things that you own is getting you, so you've got exposure to that growth, and then you have control over that, so to speak. And also, I would stay well away from residential, as in buy-to-lets, like every man and his dog is doing right now. Remember, the public are a contrarian indicator investing. The public always do the wrong thing at the worst time, and every man and his dog right now is buying a freaking house with no knowledge. They're like, oh, I got some spare capital or my life savings, I'm going to buy a house and leverage up to the max. So yeah, also another way, you could get REITs, so a real estate investment trust. So you can rent where you live, or just rent, and then you could get a REIT. So it's basically buying a share in like a property fund, so to speak. Being very basic here. Yeah, and also, so this is a funny one. A lot of people say that, you know, you're throwing money, you're just burning money just by renting. Well, I disagree massively, because I mean, for a start, ownership is a fallacy. There is a big fallacy of ownership, because you never really own anything. We are just caretakers of stuff. We're only on this planet for about 100 years, and during that time we are just caretakers of stuff, so you never really own anything. And you rent a lot of stuff in your life. Yeah, so you're not really wasting money, but the thing is, I think you're actually burning more money by buying a house, because what most people aren't aware is that a rough rule of thumb is that on a 30-year mortgage, let's say you buy a 200 grand house, you will spend about 400 grand. So you buy 200 grand for the house, and 200 grand of that, and another 200 grand in interest for the banks. That's why the banks love giving out mortgages, because they know over 30 odd years, they are going to make the same amount in interest as the house that you're buying. That's wasted money. That's money you're just giving to the banks, i.e. the value of your house in interest over 30 odd years. So it's actually far better, it's more efficient to basically rent where you're living now. Any spare capital you have, put that into cash flowing assets, i.e. set up a business, grow that business up to then obviously, or other, whether you can cash flow a house, i.e. when you have that asset, i.e. your business, chucking out surplus cash, then you can use that surplus cash flow to pay off a mortgage a lot faster, or set up, run, grow it, and then sell a business. And then when you sold that business, use that to buy a house outright mortgage free. That way you're not giving the banks all of that interest. So that's that. I am absolutely sweating in here. Also, the thing is, people leverage themselves to the max, and if you were to flip it on its head, would you take your whole life savings, let's say, I don't know, 20 grand, let's say you have 20 grand life savings, would you then leverage that up 10 times, so you effectively borrowed 200 grand, and then put that 200 grand into one stock on the stock market? No, that's absurd. Yet that's exactly what people are doing. They're basically taking their life savings, they're leveraging that up to the max, and then plonking it into one asset. So one asset which is illiquid, very expensive to get into with solicitor fees and stamp duty, etc. Yeah, so going back to what I was saying, when you buy a house, it's in terms of investing, it's really quite silly, because yeah, you got one asset class, not diversified at all, in one town, in one area, in one country. It's extremely illiquid, because it takes an age to sell it, and it's a very expensive asset to get into because of solicitor fees, the stamp duty, and all the middlemen charges along the way, like estate agents, etc. So you're literally putting all of your eggs in one basket, in one country, in one asset class, and and which isn't that good. And I mean, yeah, it's just simple investing. Like if you're, for your very boring stuff, you need to own the world. So one of my best mates, or a really good mate, is a guy called Andy Craig, and he is the author of How to Own the World. And what he says in his book, by the way, get that book, it's freaking amazing. Is basically you need to own the world. You need to own every asset and every, or you need to spread your money across every asset class there is. And then you need to diversify geographically and via sectors as well. And that way you own the world, not by having one asset class, like one thing. And also when you look at the smart money, well, guess what the smart money is doing? The smart money is exiting the residential market. The government is trying to force people out by changing all the rules and regulations to make buy-to-lets not as attractive. For those of you who have a buy-to-let or a house that you rent out, if you don't know what clause 24 is, you need to get clued up, because you will no doubt be in a position where you're probably making 5% yield or even 7% yield, but with clause 24 you're going to end up breaking even at best. I know so many people that have had profitable portfolios and now they're losing money because you can't claim the interest, offset the interest now. So yeah, that's that. So this is a long and boring video, but this is what I would do. And this is exactly what I am doing. About 3 years ago, probably about 5 years ago, I had a bet with a close friend, and we're both roughly, in fact, we're about the same in terms of financial wealth, so to speak. And he plonked 24 grand into a house deposit and said, "Siam, I'm going to be richer than you, blah blah blah. I'm going to basically get a house, blah blah blah." And we had a did you hear that? And yeah, so he's still on that mortgage, is paying off his house nicely, and instead I put that 20 odd grand that I had into businesses. So I've set up, run, grown, sold businesses, and the thing is I can now buy his house outright mortgage free and still have surplus cash. And the thing is, so what I'm recommending isn't for everyone, but if you're in a wealth generating phase of your life, so if you're, you know, I'm 31 years old. I thought I was 30. I'm 31, right? So I'm relatively young. So, and I want more in life. So I'm in an aggressive wealth accumulation mode. And the way to accumulate wealth is by cash flowing assets. It really is. People are so fixated on like buying something for it to rise up in price or value, silly percent, when real wealth is the continual accumulation of lots of small wins, and also cash flowing assets. That's it. And businesses, well, business is one of the best asset classes out there. So yeah, rent, do aggressive skill acquisitions and knowledge acquisitions, learn about new stuff, set up a business, run, grow and sell it. And it's not going to happen overnight. It's going to give it 5 years. I would literally bust the gut for 5 years and see how things go. I promise you, you're going to be amazed at where you take yourself. And the one last thing, there's a lot of random points in this, but it does make sense. We are witnessing an economic revolution right now. We really are. What's happening in the financial world with cryptocurrencies and blockchain is just unreal. I feel privileged to be alive during this stage, because everything that you'll ever hear, feel, see, touch will have blockchain all over it over the next 10 years. And money as we know it, currency as we know it, will disappear, and every currency on the planet, I think, will be a cryptocurrency within 20 years. The pound as we know it is not going to exist. And like right now, the foreign exchange market is a $1.4 quadrillion market per year. Right now, cryptocurrency is $100 billion, so that's 0.4% of the FX market. All of that's going to be absolutely eaten up and absorbed by cryptos. So I would, if I were you, I'd spend an hour or two every single night instead of Netflix or whatever, and just learn as much as you can about blockchain and cryptocurrencies. Hey YouTube, Facebook, Internet, it's Siam here. Here with Matty again, and we've just spent the last few hours sat here in the kitchen table, and we've just recorded our crypto course. So I'm being inundated with emails and messages about questions about cryptocurrencies, Bitcoin, Ethereum, and all that sort of stuff, and how to invest in it, etc. Now, unfortunately, cryptocurrencies is a lot harder to get into than buying, a stock or a share or, a tracker fund from your Hargreaves Lansdown account or something. And it is a bit of a minefield. I've lost a fair bit of money already by being an absolute dick, by sending things to the wrong address and So I've created a bit of a crash course. So it's only a few hours long, but we go through, what exactly you need to set up and how to set it up, how to transfer your pounds or euros into crypto into your account so you can buy cryptos with it, and then how to store it, because that's the key thing there. So many people are getting hacked, so you need to be able to store it properly. And also I share with you how the two main methods that I'm using to get into the market and my strategy around it, and when I'm going to exit. And also the exact ones I've got into. So click on one of the links or buttons below, or wherever Matty's going to put it. The course is cheap as chips. We want to get it out there to as many people as possible, and hopefully see you on the other side. Cheers, bye.